I think you could just see the first quarter's earnings as being a write-off. I think the market last year, particularly the S&P, really priced in some significant earnings growth this year, a 30% return on the market versus zero earnings growth in 2019. And I think from that point of view, the market has to do 4 quarters work in 3 quarters, and that's going to be a little bit of hard work, we suspect.
And what about Europe? I mean, clearly the number of cases is elevating there, and the growth environment there was more precarious to start with.
Yes, that's absolutely right. And I think that from that perspective, the valuation differential between the US and Europe is justified. The sector differentials clearly make a difference as well because it's a value-oriented market relative to the US, certainly. But I think, you can't imagine Europe outperforming the US in this scenario.
You said that the first quarter would be a write-off for earnings.
Yeah.
I mean, you have Goldman Sachs today talking about no growth for earnings for the entire year. What about beyond the first quarter? Well,
it's entirely true. I guess the question is whether or not we can ascertain what the incubation period of the virus is. I think if we can do that, then a plateauing of the number of cases will be potentially a signal to the market to buy. And that being the case, then the economic confidence that we would have lost will return. But clearly, as we go further on, supply chain could be another issue as well. So there is quite a lot of contingency around as regards to kind of things we need to see to get confidence back. I wouldn't see the whole year as being a write-off, but it's going to be a challenge to meet the year's earnings numbers.
So something like 2 to 3% in earnings growth, is that kind of your best case at this point?
I would say so, yeah. I don't think we can look for a whole lot more than that because maybe the second half of the year will have to take all of the heavy lifting.
When we look outside of the US, Paul, are there any countries that have sold off in lieu of all of the market selling off that you don't think are so affected yet and look particularly attractive?
I guess you can sort of look at some of the emerging world, actually, which seems counterintuitive, really, in the sense that this is a kind of Asian problem. But you may want to look at areas like India, which could possibly benefit from this. They still have growth. They still have a accommodative monetary policy. But I think that, you're going to see this outbreak everywhere, and I think that we'll sort of reset back to zero as a result of that.
And sectors in Europe in particular that stand out as being valuation reasons attractive?
Well, I think the story, if we get monetary policy support, which is what the market has hitherto depended upon in these situations, could well lead to a situation of buy the rumour, sell the news. So from that perspective, Treasuries are already pricing in quite aggressive Fed action. What could well happen when that Fed action occurs is that bond yields could actually go up, and then it would be value sectors. So maybe things like automobile, parts, those kind of things could do a lot better.
I was just going to ask you what you make of the 10-year yield trading below 130 and just what that spells. But besides just more Fed easing, what else is that telling us?
That's telling us that the chances of deflationary bust have come back onto the table again. And I think the thing that the Fed will be weighing up really considerably at this stage is whether or not cutting rates aggressively at this point leads us into that same cul-de-sac that the BOJ and the ECB have found themselves in, and something that the Fed has been determined to avoid. And I think if we go there may not ever be any coming back. So that will be really heavy on their mind. So from that point of view, the market is getting very worried about that disinflationary, slow growth environment.
What chance do you put on that? I mean, your global funds, are you overweight or underweight the US?
We're underweight to the US. That's mainly on valuation grounds. Having said that, 58% of the world index is in the US, so you can have 50% and still be sharply underweight. So we do have a significant aspect of the portfolio in US equities, but we do feel that valuations are a little bit stretched.
And what about gold? I mean, clearly it's worked fantastically as a hedge, but it's run up pretty strongly. Have you got exposure there?
We don't, and we've never really been comfortable in recent years with gold stocks. Gold stocks haven't tended to act necessarily in line with the gold price. If you could buy the physical or the ETF, that's been a little bit more of a successful place to be.
So are you saying this whole notion where the U.S. outperforms because it's got better growth prospects and higher interest rates sort of gets flipped on its head? Go somewhere like emerging markets where the valuations are cheaper now that coronavirus is a big threat here?
Yeah, and I think in that environment where we sort of see bond markets get well ahead of themselves, and then you actually see maybe a little bit of bonds selling off once action comes in, that should benefit those value-like sectors. It should also benefit the more cyclical parts of the market, and that would include emerging.
So is it just valuation while you're underweight U.S.
We are.
Within your 58%?
That's
so
right.
What would it take? Like, how much more of a correction would you like to see for you to feel comfortable to increase that weighting?
Well, I think that for me, we were just talking about the market looking oversold on an RSI basis, and that is starting to look attractive. But I think you only really nibble from here.
Yeah.
I think really diving in, I think, is probably too soon. We had a bigger sell-off than this in the fourth quarter of 2018, and that wasn't based upon anything as potentially widespread as this.